You've seen the headlines. China is dumping U.S. debt. $850 billion on the line. Mortgage rates about to explode. The dollar on the brink. Sounds catastrophic. But before you buy into that narrative, slow down. If China sells U.S. treasuries, does America actually collapse? Or is this just another dramatic oversimplification designed to trigger fear instead of understanding? Let's break this down properly. The number everyone throws around combines U.S. Treasury securities and agency debt tied to housing institutions. It sounds enormous, and it is a large number in isolation. But scale matters. The U.S. Treasury market is over $25 trillion in size. China's holdings are significant, but they are not controlling. And here's something most people ignore. China has already been reducing its treasury holdings for years. This is not a sudden attack. It's a gradual diversification strategy managed by the People's Bank of China. Why would they diversify? Simple. Reserve managers don't concentrate risk if they can avoid it. They adjust for geopolitical tension, currency exposure, liquidity needs, and portfolio strategy. That's not financial warfare. It's asset management. For decades, the system worked in a symbiotic loop. China exported goods, the United States paid in dollars. China recycled those dollars into treasuries. That kept its yields low, supported American borrowing, allowed U.S. consumers to enjoy cheap imports and cheap credit. It was mutually beneficial, but geopolitics changed. Tariffs, technology restrictions, and strategic rivalry shifted incentives. So China began diversifying reserves. That doesn't automatically mean they are trying to detonate the system. Now let's get mechanical. In bond markets, when prices fall, yields rise. If China sells treasuries aggressively, bond prices drop and yields increase. Higher yields mean higher borrowing costs. That part is correct. But the assumption that no one would step in to buy is flawed. The U.S. Treasury market is the deepest and most liquid bond market on Earth. Buyers include pension funds, insurance companies, banks, mutual funds, foreign governments, and domestic institutions. If yields rise, bonds become more attractive. Capital is yield sensitive. At some level, higher yields create demand. Markets reprice. They don't implode instantly. Mortgage rates track the 10-year Treasury yield more closely than the Federal Reserve's short-term policy rate. So yes, if Treasury yields spike, mortgage rates likely rise. But mortgage rates are influenced by inflation expectations, economic growth outlook, and term premiums as well. China is one participant in a massive global demand ecosystem. It's not a monopoly buyer holding the system hostage. There's also the argument that liquidity buffers are gone and the system is fragile. It's true that certain liquidity facilities absorbed excess cash during unusual periods. Those were temporary tools, not permanent backstops. The real constraint on U.S. borrowing costs isn't foreign selling, it's fiscal math. If deficits remain large in a higher rate environment, yields rise because supply keeps increasing. That dynamic exists with or without China. Then there's the banking system angle. Rising yields reduce the market value of previously issued bonds. That creates unrealized losses for institutions that bought bonds when rates were low. We saw stress in regional banks when depositors fled and liquidity tightened. But unrealized losses only become realized under forced selling. If banks can hold bonds to maturity, the principal is returned. China selling bonds does not automatically trigger depositor panic. Panic is psychological. Markets are mechanical. Another layer to this conversation is gold accumulation and so-called de-dollarization. Yes, central banks, including China, have increased gold reserves. Gold carries no counterparty risk. It's politically neutral. But replacing the dollar's dominance in trade invoicing, commodity pricing, and global contracts is not a short-term process. The infrastructure supporting dollar dominance took decades to build. It doesn't unravel because of headlines. Here's the uncomfortable truth. The biggest risk to U.S. bond stability is not China. It's persistent fiscal imbalance. If the United States runs multi-trillion-dollar deficits while interest rates remain elevated, interest expense compounds. Debt issuance increases. Investors demand higher compensation that pushes yields up structurally. This is arithmetic, not geopolitics. Which if 10-year yields settle at 5 or 6% long-term, mortgage rates remain higher than people became accustomed to over the last decade. Housing affordability compresses. Asset valuations adjust. Growth slows. That's not collapse. It's repricing. The ultra-low interest rate era from 2010 to 2021 was historically unusual. Cheap capital inflated asset values across the board. A normalization of rates simply reverses that effect. Some argue that traditional portfolio strategies are broken. The classic 60/40th stock bond allocation struggled during inflationary surges because both asset classes declined simultaneously. But that doesn't mean bonds are useless. It means duration risk matters. Long-duration bonds are highly sensitive to inflation expectations. Shorter duration instruments behave differently. Asset allocation must adapt to regime changes as portfolio management, not systemic doom. There is a rational takeaway buried under the fear. Counterparty risk and leverage matter more in high-debt environments. Real assets can provide diversification benefits. Liquidity matters. Understanding duration exposure matters. But extreme positioning, selling everything and moving entirely into one asset class is rarely optimal. Gradual structural adjustments outperform emotional reactions. The most exaggerated narrative frames the outcome as binary, either hyperinflation or depression. That's simplistic. Advanced economies typically experience slower growth, moderate structural inflation, gradual debt dilution, and policy adjustments over time. Financial crises are usually drawn out, messy, and incremental, not explosive overnight events triggered by a single seller. So what happens if China keeps reducing exposure? Yields may drift higher at the margin. Markets absorb supply. Domestic buyers adjust. The Federal Reserve maintains tools. Fiscal debates intensify. The system adapts. Volatility increases, but collapse is not automatic. If you want to focus on something meaningful, focus on debt-to-GDP trajectories, structural deficits, inflation, persistence, and long-term productivity growth. Those variables determine sustainability. Geopolitical tension adds pressure, but arithmetic determines outcomes. The idea that one foreign creditor can single-handedly detonate the world's largest bond market sounds dramatic. It's also an oversimplification. The deeper risk is domestic fiscal discipline in a higher rate world. Don't prepare for cinematic collapse. Prepare for structural repricing. The most dangerous financial losses rarely come from the events everyone screams about. They come from slow shifts people dismiss as background noise until portfolios are already misaligned. China selling bonds is a headline. Debt dynamics are a system. Systems don't break from one lever alone. They strain from cumulative imbalance over time.